As a good steward, you have to tell your money where to go. And a part of proper stewardship and planning is planning for what you expect to receive. When it comes down to money, we have to take the guess game out of it and make the best strategy win. You have to run your finances like a business. So, proper budgeting, forecasting, planning, strategy, all of these things are necessary if we want to not only grow our finances and increase our earning potential, increase our cash flow, but to develop the discipline that we need to be a good steward. We don't want to get the money and then waste it. So discipline is key, and you build the discipline for the surplus that you expect before you receive it. So if you are currently operating at $100,000 level and you want to get to the $1 million level, you want to get to the multi-millions, then you build your capacity for that before you receive it. So the discipline of your regular budgeting, your saving, your investing, these are the skills and these are the muscles that we need to exercise before we can go to the next level. There is a scripture that says, to whom much is given, much is required. Using also the parable of the talents, he who is faithful in a little, God will give you more. So when of the talents as well, the person that ended up with 10 talents at the end of everything, he received the 1 talent that the person didn't invest. So we know the story of the parable of the talents. One person got 5, one person got, I believe it's 2, and one person got 1. The person that got 5 doubled it, gave it back to God. The person that got 2 doubled it, gave it back to God. So that's 4. And the person with 1 buried the talent, and God took the talent from the person that had 1 and gave it to the person that ended up with 10. So it is an expectation for us to multiply whatever that we've been given, and in order to multiply, there are certain strategies that we can implement to build our capacity for surplus. So in this video, budgeting is important, and a lot of times when persons hear the word budget, they automatically think something that is restrictive, and it doesn't have to be restrictive. Now, based on your current cash flow, you must have some strategy, some direction as to where your money is going. You need to know where your money is going at all times. So naturally, you'd have to create a budget for your current cash flow. However, you also have to create a budget for your expected cash flow. And to, allow the message to hit home, I'll be doing an example with I created a profile for someone, and we're gonna use a sample budget for this person to illustrate then what it really means to budget for surplus. Also want to share that cash is king and cash flow is king, and there are also degrees to liquidity. When you're budgeting, I said before that you should run your finances and your life as if you're running a business. And businesses have budget meetings, they have targets, they have quarterly meetings, they have financial statements at the end of the year, they have their annual reports. And for companies that are listed on the stock exchange, they also have what we call market cap, which refers to the market capitalization. And we know about Tesla that has $1 trillion market capitalization. To kind of mirror it to what it would mean for you personally, it would essentially synonymous to your net worth. And a part of budgeting is you have to also track what your net worth is, because a lot of times we have goals, but a goal without a time frame and a strategy is just a wish, right? So when you are accurately, there's also the quote that says, what gets measured gets managed. So in order for you to, one day I want to be a millionaire, you have to know where you're starting from and the gap that needs to be filled for you to get from where you are now to where you want to be. So knowing your net worth also allows you to track your progress and see what your actual growth is. So to tie in with this video, it's one, you need to track your net worth, and your net worth is simply your assets versus your liabilities. If you have no assets and no liabilities, then your net worth is zero. If you have liabilities and no assets, then you have a negative net worth. If you have assets and no liabilities, then you would have a positive net worth. And all right, so this is the net worth template that I created, and you can see that we have the date on it. So every time you check your net worth, you should include the date just in case there are any changes. And this is something that can also be included in your estate planning, because on this spreadsheet, your estate or whoever it will be in charge of your estate can have an idea of all the accounts and all the information that comprises your estate, and information specific to the different bank accounts, investment accounts, etc. So if you look at the top left, you will see the aim of the portfolio. So remember, I was saying that run your life like a business, you need to have goals. So these numbers are examples. I just threw some numbers in there to create a sample. We're going to say that for this portfolio, it belongs to a gentleman, because I wanted to include a Rolex watch in the example. So Google the cost of like a typical Rolex watch. And let me just zoom in because I want you to see the aim for his portfolio is 10% portfolio growth year over year. And this measurement of the 10% will be simple, because once he inputs information into all of these cells, the overall net worth will automatically calculate, and he can track if he's on target for his growth. His asset allocation aim is to have 10% of his portfolio in cash, 25% in stocks, 30% in businesses, and 35% in real estate. Now, his portfolio is not balanced according to his allocation just yet, and that's okay. He has the aim, and he's actively working towards meeting the aim of his portfolio. He invests in cryptocurrency. He only has $10 worth of Bitcoin, and that's in his CX.io account. His retirement, he has not gotten an updated statement from his provider. So based on contributions only, his retirement fund stands at $450,000. He has a gold ring and a Rolex watch. Now, when we scroll down to the fixed assets section, we see that he actually has a property, market value of which it says 30 million to the side. Ignore that. I didn't fix that. But market value stands at 45 million Jamaican dollars. And he has limited furniture and appliances there now. He's still in the process of furnishing, and all of his furniture and appliances come up to $1 million. He has an electronics company, and because he's 100% shareholder in that company, his assets and cash, I could do a breakdown for this, but for simplicity, I'm just gonna say that the value of his shareholdings in that company is $3 million. I'm not going to get too detailed. Now, for the liabilities, he has $25 million left on his mortgage and $50,000 in credit card debt. So when we subtract, his total assets stand at $57,460,010, and total liabilities stand at $25,050,000. So when we subtract the 25 from the 57, we get $32,410,010. And using a USD rate of 160, his net worth in USD would be $202,562.56. I'll also get into degrees of liquidity and everything, because you have liquid assets and you have illiquid assets. So real estate, an asset. If you have a motor vehicle, that's an asset, and it's an asset in the grand scheme of things when you're doing our net worth. However, if you want to get technical, an asset can also be described as something that generates income for you, or something that doesn't detract from your income. So if you have a vehicle and you're using it as a taxi, then some persons would more so classify that as an asset versus your personal vehicle, which just costs you and doesn't necessarily earn you any money. So there are different trains of thoughts when it comes down to motor vehicles. However, we're going to just use, we can include a motor vehicle under the asset column. Depending on whether you own your real estate or your motor vehicles outright, we would have a duplication under the columns, meaning let's say, for example, using the example of real estate, if you have a mortgage on your home, the equity that you have would be an asset for you. However, the liability aspect would naturally be under the liabilities column. Now, let's use numbers. Let's say, for example, you purchase a property that costs $24 million and your deposit on that property was 14 million. So you take up cash out of your pocket and you have made that down payment of $14 million on this property. Your equity in that property would be $14 million, and that would be included under your asset column, and the liability aspect, which you have in the form of a mortgage, would be included under your liabilities column. So same property, however, you have two different entries. One, assets, put the value of the property under your asset column, so $24 million, and then you would record the liability of $10 million under your asset column. So if you just owned that property, your net worth would be $14 million, because you would subtract the total amount that you have, the value of the property, which is $24 million. You would subtract your liability from that, and you get a $14 million net worth, which is a positive net worth. Those are three main themes or points that I want to bring out. One, your net worth. Two, your budget. And three, budgeting for surplus. Your illiquid assets would be your real estate, if you have a yacht, if you have a motor vehicle, if you have equipment such as a tractor or a backhoe, if you have watches are considered investments, if you have a Rolex or any designer watch, if you have a designer bag. So what's that bag? A Birkin. A Birkin is considered an investment because it also an asset because it increases in value. However, this is illiquid because you'd have to sell the bag to extract the value if you need the cash. So this is why I say cash is king, and you also have degrees of liquidity. Now, in terms of degrees of liquidity, the most liquid is cash because it's physical cash, I would say. And that's just, these are just how I quantify it in my brain. So you have physical cash, which is the most liquid because there is no barrier per se. If you go and want to shop right now, you can use your cash and transact. And this is why we say cash is king. Now, the other degree of liquidity would be cash in a bank account, or if you're into cryptocurrency, it would be cash in a digital wallet, or if you have a cold wallet like a ledger. This is like a second degree of liquidity because there is a barrier. Using the same shop example, if you go to the shop and you can use your cash, that's the most liquid. If you go to the shop, however, and you want to use your card, they're going to say, okay, miss, the card machine isn't working. You have the cash, but there is some friction there in you having access to that cash, right? So that's the second degree would be money in an account, or whether that account is like your bank account or a digital account, like your hot wallet, which is like the phone version of what you use to store your cryptocurrency. The third degree of liquidity, I would say, is invested cash. So cash that is invested in the stock market, or if you have a bond, or yeah, like anything that creates an extra invested cash, meaning whatever you're invested in. So if it's a fixed income kind of thing, stocks, whatever, in order for you to get access to that cash, you would have to close out that investment or sell the stock or whatever. So it still counts as an asset, but it's still a liquid asset. It's just not as liquid as physical cash. the reason why I'm saying all of this is because the aim is to have, when you are planning your net worth, we're going to use percentages. So the aim is to have a portion of your net worth across different percentages of these categories. So some of your net worth would be in cash, some would be in bank accounts, some invested, etc., etc. And depending on your financial profile or just what you want for your life, you get to determine the percentages that you want to use for across these investments. So let's say and I'm going to use examples so you can have an idea. So let's say you're doing your net worth, and based on your, when you're doing your proper tax planning, estate planning, all of these things, you've decided that, okay, I would like 60% of my net worth to be in illiquid assets. So whether that be real estate or whatever the case is, you get to determine, okay, you get to determine how you allocate that 60% across motor vehicles, property, equipment, inventory for your business or businesses, whatever, right? Across your watches, designer bags, etc., etc. Of that 40% that you expect to have in cash, you can say, okay, I will do 5% or 10%, it's 40%. So let's just do, I will do 35% of my net worth in invested cash. I will do 2.5% in a bank account, and I will do the remaining 2.5% in cash. That's an example, and you have that guideline then of how you want your net worth to be set out. And this is important because when you are planning, and again, we're running our finances like a business, you have to know numerically where your money is and what your money is doing, so you can track growth. You can say, okay, when your portfolio grows, you can say, all right, now my cash holdings are surpassing this percentage threshold that I have, so this means that it's time for me to make another investment, whether because of the ratio that you have, you want to keep that 60-40. So you can say, okay, my cash holdings are increasing, I'm going to use this extra money to purchase some real estate so I can maintain that equilibrium that I would have preset, right? So you can get why these percentages are important, and you can get why when it comes down to your net worth, knowing how you want your financial portfolio to be set up allows you, without even thinking too much, to know exactly what you need to do, right? Because just by percentage growth, when you track, you can say, okay, I need to do this, right? What gets measured gets managed. Now, for the purpose of the video, which is budgeting for surplus, I have created a profile for a young professional female who has an undergraduate degree and currently lives with her parents at her parents' home and drives her parents' car. So let's just say her mom works from home, and her mom has a vehicle, so she drives her mother's vehicle to work. Now this young professional, this female, because that's important, and you'll find out why, because female expenses, in my estimation, are completely different from male expenses. Are not completely different, but there is pointed differences, right? Cool. So this young professional female earns $150,000 per month, and I'm gonna do the breakdown of how she budgets for this. Now, when you're doing your budget, before you do your budget, actually, you write out what's important to you. You also write out your immediate expenses, and then you do your budget. So why I say what's important to you, I'm a Christian, so I'm gonna tithe 10% of my income. For someone that's not a Christian, that's not necessarily a priority or a huge value for them, so they may choose to forego tithing, right? So you write out your values, one, and then you write out your expenses, because these are things that have to get paid. So based on this female's value system, she's a Christian also, so she's gonna tithe 10% of her income, which means that of the $150,000 that she makes, 10% goes to tithing, and this 10% of her income would be $15,000. In terms of her expenses, it would be, actually I'll just like go down. So her primary expense is that even though she lives with her parents, she is in charge of the water bill. So that's like peak expense. Her only real expense would be the water bill, and then the rest of her income, she gets to decide how she budgets and spends this money. All right, so this young female professional is also interested in growing her financial portfolio. So she also, in addition to tithing 10%, she also invests 10% in the stock market. So right off the bat, after her tithes come out, 10% also comes out for investments, and that's $15,000. And this budget is in Jamaican dollars, clearly. Or not clearly. Anyways, so after her tithes and her investments come out, she is left with $130,000. Her parents primarily buy most of the groceries, but she's also a picky eater, so she also buys groceries, and she has an appetite. So she spends $35,000 a month on groceries, and this brings her, I guess you can say, running balance to $95,000. You know, I should double check these numbers just in case my math was off, but I think I'm fine. So her running balance now becomes $95,000 after her groceries come out. This is the sample budget template that I've created. You will see that there's a revenue goal and everything here is being tracked. Over the cash flow stream side, we have space because she needs more than one income stream than just her corporate job, and we'll have a total calculation for that when she decides to add more income streams. Now, a quick breakdown: tithes goes to church. For her investments, she purchases $10,000 worth of Trans Jamaica Highway stock per month and puts $5,000 in savings. We have $5,000 for the water bill, the groceries, lunch, car wash, which is twice a month, gas for the month, her gym membership, her nails, going out with friends, and her subscriptions. And that's how she spends her $150,000 salary per month, and it's $150,000 after tax. So this $150,000 is net. Now that's her typical budget. However, she has to budget for surplus because okay, and this is important too. In order for you to budget for surplus, you have to know what your goals are. So goal setting before you do your budget is important. So for her, she has 4 main goals. She wants to build her financial portfolio, which means that she has to now consider getting insurance, life insurance, critical illness insurance, health insurance. She wants to build her financial portfolio, so she has to consider having an emergency fund. She has to consider what kind of investment she's doing. Is she going to continue doing stocks, or is she going to try bonds? What is her risk profile? All of these have to be considered before she knows what she's going to do, right? She also wants to build her credit by applying for a credit card. And all of these things, important. Another thing that she wants to do is travel, and she has to start a fund for this so she can pay for her flights, she can pay for her meals, excursions, hotels, or whatever accommodation she chooses, right? And these are just her general goals, and her long-term goals is to buy a house and to buy a car. So we have 4 categories here based on what she wants to achieve in the future, right? So in budgeting for surplus, the easiest way to do this is to use a percentage-based system. So of her 4 things, building her financial portfolio, traveling, house fund, car fund, she can split everything right down in the middle and say any money where she gets, 25% goes to her building her financial portfolio, 25% goes to her travel fund, 25% to her house fund, and 25% to her car fund. And this is the easiest, or the most simple thing to do. However, again, we're working with numbers, so we need to establish then the time frame that it will take her to accomplish these things. So if she earns an extra $50,000 per month. This means that using the percentage-based system, the percentage-based system is fine, but we have to know what that means numerically. So an extra $50,000 per month means that 25% of that being 12,500 means that 12,500 is going to her financial portfolio fund, building her financial portfolio. 12,500 is going to her travel fund, 12,500 to her house fund, and 12,500 to her car fund. If we do some quick math, this 12,500 multiplied by 12 months, 12 months in the year, at the end of the year she would have, that's 10, so that's 125,000, 125, 250. So at the end of the year she would have an extra $150,000 in each of these accounts. Now again, we're really crunching down the numbers. In her financial portfolio fund, which includes her emergency fund and investment and all of that, that's 150K. Travel fund, 150K. House fund, 150K. Car fund, 150K. At the end of the year, she's gonna look and say, okay, where can I travel with $150,000? Might be able to book, a hotel on the North Coast with that, but she also wants to travel overseas. So her travel fund for further destinations or farther destinations, if she wants to go to Europe or those far out countries, because she's Jamaican, so that's multiple flights, visa applications, all of these things. She realizes that maybe $150,000 may not be enough. It's definitely not enough to do the kind of traveling that she wants to do. She wants to stay at nice hotels. If she's traveling for more than 10 hours, she wants a business or first class seat, and those are not cheap. So knowing really, you can see how really knowing exactly what you want and working backwards allows you to say, okay, this is what I need to do. So that's just for travel. With her house fund, if she continues on the same trajectory, saving the 12,500 or allocating that 12,500 per month to her house fund, at the end of the year, that's $150,000. But if you extrapolate at the end of 10 years, if these monies are in a regular savings account, that's just $1.5 million. Now, she hasn't determined what area she wants the house, if she wants to buy the land and then build, but extrapolating with her current savings, that's $1.5 million at the end of 10 years. Now, she has to say, am I going to wait 10 years to save $1.5 million, or is there a faster way to achieve this? Now, this is why budgeting for surplus is important, because it allows you to see the practicality of achieving your goals and what you need to do to fast track the accomplishment of your goals. Now, based on this exercise that this person would have done, she'd say, okay, maybe $50,000 a month across all these things. It's not going to be enough, so I need to find a way to make some more money so that I can allocate more money using the same 25%, but 25% of 50,000 is different from 25% of 100,000, and 25% of 500,000 is different from 25% of 100,000. So the percentage remains the same, but the percentage of the money that you find in the percentage of is going to be different. It's going to give you a different answer. So if she wants to fast track her results, she's going to say, okay, maybe an extra $50,000 a month is not going to cut it. I need to do an extra 100K a month. Now, because we already worked that out, we're just doubling. So instead of having 150K at the end of the year, she's going to have 300K in these different accounts. And at the end of 10 years, instead of having $1.5 million, she's going to have $3 million. Now, I'm not accounting for interest, because interest on a bank account is negligible either way. And based on this exercise also, it would cause her to think, maybe having this money in a savings account is not the best place to put these funds for these long-term goals. It may very well just signal to her that for my house fund, for my car fund, I need to put these monies into a different type of account that can give me more interest on my monies, so that it's not the dead money when we put it in, when we're ready to eat, me I gotta take out. No, she wants to put these in investment accounts or invest them in different whether securities or whatever it is, so that she can give herself a little boost, like get some money on her money as she pursues her goal, her financial goals. Now, I could expound on this, but the concept is pretty much clear on what it means to budget for surplus. So if someone comes to her and gives her $100,000, she's not gonna waste it, because she knows exactly what her goals are and where she needs to put these monies. And it doesn't matter the amount, it's percentage based. So she has a clear direction. All she has to do is, if it's $100,000, somebody, her auntie give her $100,000, she's gonna say, okay, 25% of 100,000, and she's gonna allocate into her different accounts. And all these monies aren't going into her operating account. And I say operating account because we're running our finances like a business. When you're doing your budget and setting up your finances, you need multiple accounts. Businesses have what we call operating accounts, and this is typically like a checking account, because we're transacting on a daily basis and we don't want the fees that come with different types of accounts. So your operating account in your personal life would be the account that you transact from. You pay your bills, you pull from the ATM, like whatever it is, that's your operating account, because the money that's in there, you're gonna spend it. You need different accounts that are, again, we're taking the guess game out of money. We're removing the friction and the barriers. We don't want you signing into your account every day and seeing the money that you have in savings. Because you're gonna say, yeah man, I have money, I can do this, I can. No. We want to have the outer sight, outer mind approach when it comes on to different types of accounts, so that you are not constantly bombarded with this and you think, say, you have money, right? You're not gonna say, okay, this is actually for my car. You're gonna say, oh, let me just take some out of this to order this online or whatever it is. And when I say out of sight, out of mind, I don't mean that I mean that in terms of like your day-to-day, but I do advise and recommend that persons check their investment accounts and different accounts on a regular basis, so that you can easily identify if something is wrong. If money comes out of your account, you're supposed to know. So you check your operating account, you check your investment accounts. I just want to see that it's there, right? So I mean, if you're going to pay your bills, I don't want you to be seeing like all of the different accounts on that one platform, if you get what I'm saying. So for me personally, I believe in having accounts across different institutions, and it works for me. It works for me. So you have different banks, you have different investment houses, so it's nice to, you know, kind of disperse your finances across different institutions. Say for example, NTB platform goes down sometimes. So if you have your account with NTB and NTB goes down, then how are you going to get money? If you have an account with Scotiabank, you can say, okay, I can get access to cash because I have this Scotia account, just and you can use that until NCB resolves their problems. So it's good to have different accounts with different businesses and different institutions, because again, you are trying to minimize friction when it comes on to your finances. You don't want to want to make a purchase and your account down, your card not working, so many things that just create unnecessary friction. But when you have your funds dispersed across different institutions, it minimizes the headache, and that's what we're trying to do. So I hope this video helped you. I hope this video was informative. If you would like to book a strategy call to work out your budgeting and narrow down on your financial goals, you can click the link in the description box below to schedule a time and schedule a call to flesh out your finances. Not investment advice, not a financial advisor, but I can share financial information and share what I know. If this video helped you or if you learned something, please like, share, comment, and subscribe, and I'll be posting more videos like this. And if there's something specific that you'd like me to make a video on, you can also comment that in the description box below. And yeah, thanks for watching, and bye.